What's going on, options traders? Welcome back to another video. Again, it's been a while as I've been harvesting with my fellow brewers, but I thought today I'd come on and share some insight with you guys. So obviously the market has continued to chop up options traders, yet throughout this entire year, this tricky year, the trajectory of our equity curve has continued marching steadily up and to the right. And so while some say that this may just be luck, I beg to differ because this type of consistency over an extended period of time is indisputable. So in today's video, I want to show you guys exactly how we achieve these types of results by diving into a recent trade that we had on in GS, that's Goldman Sachs. As you've probably noticed with many names in the market, the overall trend is down, but if you plot the 8, 21, 34, and 55 EMAs on the daily time frame, you can easily see that for the most part, the trend has respected those averages. The idea behind 2022 is all about building up a bear position when the underlying retraces to these moving average clusters and waiting for the payout if the underlying ends up making lower lows. That's the gist. But the part that most retail traders get wrong is in how they build up the bear position. Typically what they like to do is to buy out of the money put options, but the problem is that they incur a lot of friction and premium drain. If you look over here in GS, essentially you'd have to endure about 10 sessions of sideways before the move to target happens, and by then you would have lost quite the premium in the put option. So many traders try to resolve that issue by going further out in time, but what ends up happening is they end up paying a lot more for their bias. As you know, more time equals more premium, and more premium means, well, if you're wrong on direction, you're going to end up losing a lot. So the risk reward isn't really there. So another approach many traders try in order to resolve the premium drain issue is they will purchase an option that is in the money with roughly 60 or 70 deltas. But again, that's also paying a lot more for their bias. And on top of that, since the delta is basically almost 1, they're not really getting that convexity they want. In terms of directional exposure, that type of position is almost equivalent to shorting the shares directly. So kind of a linear bet. And again, if you're wrong on direction, you're going to end up losing a lot. So the two approaches that I've just mentioned are typically the way retail options traders go about trading in these markets, and unfortunately they've been experiencing a hard time generating returns. And that sounds like you'll find what I'm about to say to be very helpful, because this is where the beauty of spreads comes in. See, when GS was up here, we really didn't care how long it took for the market to consolidate sideways before moving lower. We simply entered a bunch of spreads, sprayed them down in this area for very cheap, 26 cents, 8 cents, sprayed over the next 3 to 4 weeks, and we kind of just let them sit there during this time. The nice thing about these structures is that if we're wrong, who cares, right? It's literally pennies. We don't lose much. But when we're right, boom, we harvest. And so you can see that's essentially what happened as GS fell, and we took profits, taking a lot of these spreads off for roughly over $1, with the maximum official exit at roughly $2.43, or about plus 23 times cost. For those who continue holding into this week, they actually took some off at $4.45 or plus 4,300%. And the reason these ridiculous returns are possible is because of the nature of spreads. With spreads, we're able to really refine and reduce our cost of entry and sustain any sort of chop that the market throws at us. And so we're able to express our bias for a lot cheaper than what the average retail is able to do. And because of that, when paydays come, we're essentially achieving the Wall Street bets type returns that everyone desires. We're just doing it on a more professional level because we're harnessing the power of spreads, while others are churning mediocre 20 to 30% wins at best while fighting decay in this choppy environment. And at the same time, when the underlying does not move in our favor, we only lose a little bit because our cost is so negligible, while the average retail trader loses a lot. And so in terms of expectancy, if you think about the expectancy formula, which takes into account the probability of wins and losses averaged by their respective win and loss size, what you're doing with spreads is really just maximizing the expected value of your trades, because your losers are small and your winners are much, much larger. And that's really what trading is all about. Executing a series of trades with positive expectancy, and that's what results in this equity curve that continues to trend up and to the right. So I hope this makes sense to you guys, especially a lot of the newer options traders who are thinking about taking your options trading and just trading in general to a much more advanced level. Options trading is more than just about getting direction right, and it's more about just staring at charts all day trying to scalp the intraday movements. If you're able to understand how to use spreads to your advantage, you can really swing trade in this choppy environment with the convex type payouts that we've been experiencing this entire year. Our experts at Options Brewers can help you with that because we've been through it all. So whenever you're ready to join our community, you know what to do. We'll see you on the other side.